Good morning or afternoon, depending on where you are. Welcome to today's webinar, SEC Companies Justifying the Switch to a Regional Audit Firm. Before we get started today, I'm going to go over just a few housekeeping notes. To use your webinar console, you can toggle the control tray open or closed using the red arrow on the right side of your screen. And if you do have any questions during today's webinar, please feel free to submit them for us in your chat box at the bottom of your control panel. Additionally, if you're calling in via telephone, please choose the telephone option under the audio settings. And if you're using your computer, just choose mic and speakers, and that'll give you the best audio for today's webinar. I do want to remind everyone that today's webinar is being recorded, so we'll be able to send out the slides and the recording of the on-demand webinar to everyone within about 2 days. And with that, I'll go ahead and introduce today's speakers. We have Dean Quiyambo, who spent over 12 years as an auditor and is now a partner on for our business development team, and he's labeled as the Chief Relationship Builder here at Armanino. We also have Matt Peralt, who is Armanino's audit partner leading our SEC and technology practice. Matt has over 20 years of experience in IPOs, mergers and acquisitions, and supporting over 30 technology sector transactions. And with that, I'm actually going to pass it over to Dean to get us started today.
Thank you very much, Megan. First off, to understand kind of what's going on in the SEC and public landscape, let's kind of understand what's going on in the current IPO landscape. And with that said, I'll switch it over to Matt Peralt.
So 2 charts here. The one on the left shows the number of IPO filings that have taken place over the last 9 years, and on the right, just the same data on a monthly basis. And you can see last year there was 365 IPOs, so effectively one every single day. And on 2015, 147 year to date, so we're pretty much at the same pace. The markets are healthy, and a lot of companies are going, and this is, I'd say the number of filings is indicative of the number of companies that are actually going public. So, the impact this is having really on the accounting landscape and the audit fees out there is that all of the firms, certainly the larger firms, are very busy, and they are looking to maximize fees across the board because they realize these companies going public, they're going to really pay any fees that are demanded of them so that they can get out and get that public capital that they need. Next page here just gives us a breakdown by industry. Certainly in the Bay Area, I think technology would be a greater component. I'm not certain if this data is by company or by revenue total, but it just gives you a good idea of the sort of dispersion of companies that are going public. And this is, again, all companies in the U.S. for 2015, so those 147 companies that we just saw on the previous graph.
So this really shows you the timeline of a typical IPO readiness process, and you can see it's a 24-month process. So the other thing that's kind of affecting the current public accounting landscape is, yes, there was effectively a company that went public every day last year, and we're on the same pace for that this year. The other thing is that what we're not seeing is all of the companies that are planning to go public in the remainder of 2015 or are planning on it in 2016. That as well is using up a large amount of public accounting resources. And as we all know, and thankfully for Matt and I, there still is a shortage of qualified CPAs out there, which keeps everyone in high demand, which, as Matt said, is causing an era of fee maximization. So that's why the fees are continuing to rise, because of the IPO environment and then the readiness of those who also want to go to market and take advantage of the strong public markets.
And as Dean said, it's not just the finance organization, although that typically is where the focus is when the company is going public. There's just a lot of other things in terms of board governance and just creating enhanced systems across the company, that creating a vacuum for finance talent and folks that are system savvy as well.
So what is that doing to audit fees? What we've done is we've put together a survey to provide public company CFOs and audit committees a tool to help quickly compare your audit fees to your peers in the same revenue bracket. And what we did is we looked at 750 plus SEC companies reporting revenues and audit fees from their 2012 to 2014 10K and proxy statements. And I think you're going to find these findings pretty interesting. So what's your fee to value ratio? And really what we're asking here is, are you paying above average prices for a very average audit? You know, is the fee that you're paying to the value you're getting, to the amount of service and attention that you're getting, does it all make sense? And hopefully the next kind of graphs based on the averages and the means that we're going to show will kind of shine some light on that for you. Matt, you want to kind of take the first slide?
Sure. So the first slice we looked at was companies that had less than 50 million in revenue. Probably a significant concentration of these, at least in the Bay Area, is going to be biotechnology companies, because typically companies south of 50 million really don't go public unless you are biotech related. So at first blush, the fee of 671,000 on average for a company with less than 50 million revenue seems pretty high when you're looking at that big four category. The average drops down to about 369, and then if you look for regional firms, talking about $102,000 in total fees. So you see there's a significant discrepancy between what a firm will charge when it's the big four and when it's a regional firm. And certainly for those smaller companies, I think, you know, one of the reasons that a company south of 50 million would go with a big four is really if it's a heavily regulated industry where there's a deep area of expertise that's needed. And again, biotech comes to mind, where companies have to deal with collaboration, co-development agreements, and there may be some sophisticated accounting that needs to happen. But I think, you know, clearly what this graph shows is if you're a firm less than $50 million in revenue, you can save a whole boatload of money by considering going to a regional firm. And unless you've got some incredibly complex accounting issues, you know, I think there's a whole smattering of regional firms out there that could probably handle the issues. Interesting to note too that $671,000 Big Four fee is up 5% over last year as well.
So over the past 3 years, Matt, what does pricing look like?
Again, this graph illustrates it's a pretty ugly scenario for companies that have less than 50 million in revenue. You're talking about a 34% increase in 2013, and then a 70% increase in average fees reported in the 2014 10Ks and proxy statements. So certainly no signs of abating or even flattening for these smaller companies that are seeing substantial fees. And if you weigh that audit fee relative to revenue for a company, you're talking about a pretty staggering percentage of revenue that's getting consumed by an audit fee.
And Matt, we know what our pricing looked like. That type of increase of 27 to 34 of a 3-year increase of 70% in fees, that's got to be primarily driven by the Big Four and kind of their busyness today.
Yeah, I mean, unless it's a meteoric rise in the company's revenue, let's say a company went out at 10 million, the next year they're at 50, so they're still falling in this bucket. I mean, other than that, it's hard to explain fee increases that are that substantial, except for the fact that the Big Four and then the bigger firms are just ratcheting up fees because they can, because as that other graph showed, a lot of IPOs they could be working on.
Right, it's the era of fee maximization, as they say. All right, Matt, 50 to 100 million, what's that look like?
So again, that first graph, Big Four, you're looking at an average of $830,000 in fees, and compare that again to last year, it's up 5%. And again, you see there's just a dramatic shift when you're looking at Big Four versus regional firms. We're talking about savings of nearly $500,000 in comparing a Big Four to a regional firm. And again, these are companies, I think, when you're talking about the 50 to 100 million range, usually companies are not that complex. They don't have that broad of an international footprint. So, without looking at the detail of each of these companies, I'd, off the top of my head, say probably 75% of these companies could be effectively served by a non-Big Four firm.
And so let's see their 3-year pricing.
Again, this you do see a little bit of a decrease in the composition year on year, and this math may be a little bit skewed because when companies grow out of that 100 million revenue range, then they sort of drop out of the population for prior years, and so the absolute decrease in the fees for the population I think is not indicative of what's happening, because again, when we looked at just those companies that are in the 2014 population and did a year on year comparison, they were up about 5%. So I think consistently what I'm seeing is at least 5, 10, but I'd say probably more close to 15% is the sort of average increase. And frankly, if the Big Four doesn't find you exciting, they don't think your company is going anywhere, they're going to ratchet your fees up at least 20% probably this year.
All right, now, I mean, this is an area that is a sweet spot for so many different firms, 100 to 500 million in revenue.
Yeah, and again, here you see maybe less disparity between the national firm and the Big Four. But again, take a look at the difference between the regional and the Big Four, and I mean, we are, seeing this across the board. There's a device company here in Pleasanton that their audit fees just went from 1.3 to 1.7 million, and the company's still south of 200 million in revenue. So you're talking, almost 1% of the company's revenue is going to an audit fee, which again, when you talk about the compliance activity nature of this, most firms are not viewing an audit as something that's adding a substantial amount of value. They're saying, hey, we just need to get this done. We need to be in compliance. And what is the minimum amount that we can get it done for in a quality manner? And so when you're talking about, north of $1 million, I think it's really imperative that the companies have to ask themselves, what could we get another firm to do this for, and what kind of quality are we getting for that, pretty exorbitant fee?
Yeah, this slide is absolutely staggering when you see the type of dollars and the differences that could literally fall back to the organization for reinvestment into some of their strategic goals, maybe into hitting revenue targets or other things like that. So let's see the pricing over the last 3 years in the 100 to 500 million dollar range.
Again, 18% increase, and as you said, Dean, I don't think, if you took the composite average of earnings per share for these companies, I don't think EPS is increasing on average by 18%. So, really audit fees are outstripping their profitability growth, and that's just not a good measure for any vendor. I think, any company would tell you that one of their top strategic goals is to improve profitability, and if your expenses are growing faster than your top line, it's pretty hard to do.
Okay, now the area, 500 million to $1 billion of revenue.
Yeah, you see here, there's not, typically when you start getting into 500 million, then you are talking companies with likely a pretty significant international footprint, or really broad-based U.S. operations, maybe not international operations, but international sales organizations. And so I think you are starting to see a much higher concentration of Big Four and national firms playing in this category. In fact, the regional firm here is a composition that is exactly one company that's audited by a regional firm, and I believe it's an oil and gas company, so one that's relatively easy to audit based on actual cash receipts and not that complex. So again, though, companies in this bandwidth, you see that national firms are charging somewhere 29% below where the Big Four are. So I think if you're a CFO in this space, it's likely you're going to stick with the Big Four, just because I think this area, this size company, folks are just much more reluctant to make a change, and it's more natural to go with the Big Four. But at least it's something you should consider on an annual or every other year basis.
And let's face it, there are organizations of that size that have had impactful changes to their operations, and they're still looking for cost-saving measures. And this is an area that a lot are looking at because those fees are tremendous.
Yeah, and you see here again, I think there's more stability in the fees and the fee increases, just because Limited universe of alternatives at that level, really. And I think if one firm is going to leave the Big Four, they're going to go to another Big Four, and I think there's a lot of, I won't say collusion, but when big companies are switching auditors, they know what their competitors are paying and they know how much the audit costs, and nobody wants an audit this big to be a money loser. So I guess usually you would see a reason of a switch here is not necessarily fees, but just service and maybe some upset if there's been some restatement.
Right. This is their sweet spot, and everybody knows that these are the accounts that everybody would love to have, and the pricing is pretty stable accordingly. And there you go. Now, if you're going to companies greater than $1 billion, well, obviously this is definitely the Big Four sweet spot.
Yeah, I don't know how many firms are composed in that national. I guess there would be a few that are billion-dollar companies. Again, something that just given the size and scale of an organization that size, it's Big Four. I think is just going to more naturally be your right answer.
Yeah, that's your sweet spot. I mean, they're made for organizations of that revenue size.
And you can see again sort of a similar story here where there's not much of a fee increase or decrease year on year, just because these companies tend to be more stable in their operations just because they're so diversified, and likewise the audit firm is not going to have a significant amount of negotiating power in terms of trying to increase those fees.
Okay, well, we all just got bombarded with those slides. I think if you're a public company CFO, we don't need to say it. You feel it in your pocketbook. So, and if you're thinking about, gosh, well, how do I capitalize on those savings? How do I make potential savings like that a reality? I think what you need to consider is some of the common audit committee concerns or questions when switching to, a regional firm. Because, let's face it, what everybody's kind of used to is the Big Four and nationals. But if you really want to, maximize your dollars and maximize your return on investment, you really might want to consider that regional firm. So the things that we consistently hear from audit committee chairs, CFOs, and management are up on the board here, and you see them. We hear, well, does that regional firm have the right industry expertise? Matt started off with that when he was talking about the biotech industry. Is there an industry are you in an industry that is so regulated or transactions are that unique that you need to have an industry expert? So obviously that is always number one. Number two, you're going to have to ask and you're going to have to validate quality of work. What's that regional firm's track record? What's their PCAOB letters look like? What do their peer review look like? Next, we commonly hear, how's the market going to react when I let everyone know that I'm switching to a regional firm? We'll go over that as well. Again, this is a service, professional service, high level, high touch commitment. You want to make sure that you're going to get the right level of commitment from whoever you partner with, but especially a regional firm. So you want to explain that. You want to understand, are the processes at a regional firm different than at a national firm or at a Big Four? And then lastly, again, you're going to want to, stamp it with the fee discussion and say, hey, we've gone through the first 5 criteria here, and now we can validate it and say, yeah, we can really take advantage of the fees. So we'll go through each of these in depth. So the first one is industry expertise. And really when it comes to this area, and Matt and I have a lot of experience talking to it and talking about it, but public company CFOs and audit committee chairs want to know that you've addressed their issues before. Is there anything so esoteric that the auditor hasn't seen? So Matt, kind of walk us through some of the discussions that you have with some of the companies that are thinking about making the move to a regional firm.
All right. So I think this chart does a good job of illustrating what we try to impress upon public companies. And typically we'll start with their 10K MD&A and walk right through there, identify the significant accounting policies and then pull out of that the significant audit issues or accounting issues, and then say, hey, what other examples do you, the CPA firm, have of clients that you have dealt with similar issues? And I think that's really the linchpin there, and how many companies of comparable nature and accounting issues of a comparable nature has that firm faced, because that experience is going to directly translate into their ability to understand your business, understand your accounting issues, and make sure that you are getting to the right answer. So, certainly when we go out to any company, whether it's public or private, the first thing the CFO wants to know is, tell me the other companies that are just like me that you audit. So, this is, again, just a good layout here, I think, of saying here are the top accounting issues. We just took this sample from one of the companies, a med device company we were proposing on, and just said, hey, here's what we understand to be the major accounting issues, broken them down into a little more detail, and then not included on the slide, but what we did share with the company was just another column on the right that here's all of the companies that we dealt with that have similar issues.
Right, and that is the first layer of comfort that we can give to an audit committee chair or CFO, is that, hey, we've been down this road before. So the next thing that should come up is quality of work, right? Because at the end of the day, you're only as good as your work product. So let's kind of talk about quality. And since 2004, 1,800 companies have gone public, and 1 in 3 have filed restatements. I don't think that's something that anybody wants to be a part of, but it happens. And I think the biggest thing is that you want to have quality of work to assure that that is not you, and that's not your organization. Here you see the top 6 industries where restatements have been seen, and tech, finance, energy, manufacturing, all leading the way, and we definitely have some thoughts on that and some of the reasons for restatements. Matt, why don't you kind of talk about your experience with regards to seeing restatements in the public market?
Yeah, this graph is interesting, and I guess maybe because I focus more on technology, and this is a broad-based survey. So expenses, I think, certainly we see a lot around equity accounting, types of errors that are happening there. So it's interesting to see that leading the way in terms of total number of restatements. Certainly, I think revenue is something that we often see, income taxes, and just anything around tricky equity, whether it be warrants, stock options. But again, I think the real question here goes back to the previous slide, is what are your auditors' experience in dealing with these issues? Have they faced your business transactions with another similar client, and are they, organizing the audit team so that the right level of resources looking at these issues early on in the process, so it's not happening at the 11th hour. If you look at our public company audit practice, we've been doing this for a better part of 15 years, and I can't think of a single restatement, certainly not in the last 5, 6, 7. I know, 8 years ago when all the companies were going through stock option accounting, and some backdating of stock options, we had a few clients that we had inherited older periods, and they had to go back and restate those older periods, but nothing on our watch. So again, I think it's critically important for companies to consider this when they're making the switch for auditors, is where's your area of restatement most likely to happen, where's the highest risk, and is the firm you're bringing in capable of mitigating that risk based on their experience and the level of resource they're going to attached to your audit.
Yeah, exactly. Because let's face it, investors are sensitive to restatements. It takes a period of about 3 years. For investors will react to a restatement, and it's very forgiving if it's a simple mistake, or just no fraud or irregularity. The other thing that you could use to track quality of that regional CPA firm is the PCAOB report. When we are asked to propose on public companies, we were routinely asked for our PCAOB report and their observations of our audit work. And something that, it's a public document, and it kind of goes to just validate our work effort and what we do. And here, as you can kind of see, for us as a regional firm at Armanino, something we're very proud about is the fact that we have not had a comment from the PCAOB since 2009. So in 2010 and 2013, they came and they visited us, and we have not had a comment. So for the better part of almost 6 years, we're very, very proud of that. And all of that results in a 0% audit failure rate compared to our peers. And Matt, this is a very powerful slide. Why don't you kind of talk and add some color for everyone?
Yeah. So pretty simple math here. In each of the PCAOB reports, what they will do is identify the number of issuers that were examined, and then they will identify the audit failures for each of those individual audit issuers that were examined. And so you see across the board, all of the competing firms that we compete against most commonly here in the Bay Area, they're all failing, I'd say at about an average of a 35 or 40% rate. Some of them BDO up as high as 65%. So again, I think, it's the same PCAOB inspection team that's coming out and looking at our work papers, that's looking at the other firm's work papers. Maybe not the same number of individuals, maybe not the same number of engagements, but, I think when you talk about the fact that this is, percentage basis, it sort of solves the issue of saying, well, you guys don't audit as many, as EY, for example. I'd say that's accurate, but, if we're getting a 0% failure rate, I think it's indicative of the quality of service. And there's a reason that if you just look across the landscape, the clients of all those other firms have restatements, and Armanino does not. So, I think it's a pretty compelling proposition when you walk into a company and you can say, clearly we can beat the fee you're paying, and clearly we have a higher degree of quality that was more likely to ensure or mitigate against the risk of a restatement. And I think for an audit committee chair, those should be the two most compelling factors.
Yep. We hear that over and over and over again. One of the next common factors is, okay, well, that sounds good. We've heard audit committee chairs tell us that sounds good. How's the market going to react if I switch to a regional firm? Because the perception is switching to a regional firm increases investor risk. That's just a perception. It's not the name of the Big Four. It's not a national firm. But reality is, if you switch to a regional firm, that potentially your investor risk could go down based on the way they work with you. We say that if you work with Armanino and our 0% failure rate, your risk will go down, and we have other reasons to go prove that. Now, with that said, what actually happened? So you could see, and I'll let Matt add some color here, but you could actually see what happened when companies made the switch to at least Armanino.
Yeah, I believe it was about a year and a half ago, we were proposing on a public company, and they actually did select our firm, and the audit committee chair had said to us, I want you to put together some hard data. Show me firms that are switching from a Big Four to non-Big Four. And so we went back, I think we looked at a 4-year time horizon backwards at the companies that we had brought on board as new audit clients, and then the companies that had switched from a Big Four to another audit firm that was not Armanino. And as you can see, in either case, there was minimal to no impact on the stock price. I think we got the benefit of a couple of companies that were in a turnaround mode, and so you can see ours, our graph, the stock was actually up. I would say, my intuition tells me we weren't responsible for a 44% increase in the performance of that company's stock, but I think clearly what it does say is there's not a negative market reaction. And in fact, if the companies look at it objectively, they're going with something that's going to reduce expense and increase quality. So just by its very nature, I think it's, as long as it's explained to the market in that manner, I don't really think there's an impact. I think the scenario would be if you were to undergo a restatement, major change in business, and then simultaneously switch audit firms. I think that may scare investors because they think you're trying to hide something. But if it's just normal recurring business and you're trying to save money and there's not a substantial, huge change in the business, I think it's really something firms should consider.
Okay, that sounds great. I wish we were responsible for that 44%, but too many factors in there. But with that said, so far we've touched upon expertise, we've touched upon quality, we've touched upon market reaction. The next thing is we're auditors, and this is a professional service. So what is the service level commitment that your potential regional accounting firm can give to you and your organization? And here at Armanino, what we really focus in on is these 4 items that you see on the screen now. And these also go to prove how we can decrease investor risk and really validate that 0% PCAOB failure rate that you saw a couple slides ago. So the first is more partner time. Why don't we talk about that, Matt, and how you and your senior managers run our SEC audits and how often you're out there and how often you interact with management?
Yeah, if you compare it to the national firms, I think we're out there, if you just take the senior manager time and the partner time and add it together and compare it to what the national firms are reporting, we're out there about 20% more of the time. And for us, it's not just because it's a higher level of service, but I think it's because we believe it's a better quality of audit and it's going to allow us to do the audit more effectively, get in and out of the field faster with less disruption. The quicker you can identify an issue, the more likely you are to resolve that and resolve it in the right manner. And certainly the right people to identify those issues are the people that have the most experience. So we're making sure that our senior managers and partners are in the field early and often.
The next item is staff continuity. How many times do we hear from controllers and CFOs, I'm tired of having to train the big 4 or national first year and second year staff over and over on how to audit my company? We hear that all the time. It's one of the biggest pain points. And here at Armanino, we have a very, very strong retention rate, twice the industry average, one of the best places to work in the country for all CPA firms. So staff continuity is a big deal to be able to tell our clients that, yeah, you're going to see the same people over and over and over again. Matt, why don't you say about maybe some of your public companies, just the stability of their teams?
Yeah, I mean, several of them we've had for better part of 10 years, and it's amazing the folks that are now senior managers on those accounts were, on the accounts when they were staff. And certainly for public companies, we try, for all of our audit clients to ensure staff continuity. Whoever did the job this year is automatically rescheduled next year. But that takes on, if there's any conflicts, there's certainly public companies take on a much higher level of priority. So you really get the cream of the crop. And then when folks are progressing, if 2 staff 2s are grown up to seniors, we're going to make sure that we go to the company and say, which of the seniors now do you want to continue on the engagement? So we give you our A team. And then when that A team is growing up over the years, you get to select, handpick the folks that you want to continue on that engagement. And just given that combined with our, better than 90% retention rate, you're likely to see the same faces for several years. And it just gets to a much more effective and efficient audit.
Yeah, and we can't mention enough just how refreshing that is for our clients when they say, hey, gosh, it's so nice to see the same people over and over again. Local decision making. This one is a very big deal. We've been talking about efficiency. Matt's kind of highlighted that. The fact that Matt has the ability to make the call on his key transactions with his public clients is a very big deal. Matt, kind of why don't you talk us through our QC process there?
So on every engagement, we've got a second partner, and then we've got our technical review partner as an available resource. And certainly through our Moore Stevens affiliation, we can even reach out to those folks if there's an area of expertise that we want to tap into. Again, though, I think it's a question of reality versus perception. I think the perception is the larger firms have national offices, and therefore that's more likely to get you the right answer. And I think what we found, again, based on 0% restatement rate, is you look at the transaction, you look at the authoritative guidance, you make a judgment call, and you prominently disclose the treatment in the financial statements. And I think the risk of getting it wrong and the risk of an investor coming back and suing you and a restatement scenario just becomes that much less. And one of the things we really, really encourage our companies to do is consult with the SEC. I think there's just a historical reluctance of CFOs and controllers to consult with the SEC if there's a question. And if something is so gray that it's not clearly illustrated in the guidance out there and we can't find it, then we're going to ask the company to consult with the SEC. And it's really a 24-hour turnaround time. And it doesn't muck up the process. So it's something that we think most companies aren't taking advantage of, and we steer them to that.
And then lastly, I think this is really an ideological difference between a regional firm like Armanino and the national firms and especially the Big Four is just our willingness and our ability to help you with regards to expertise in other areas. We have the experts at a very holistic level to help you kind of with whatever you're going through. Matt, why don't we quickly touch on that?
Yeah, the most obvious example I can think of is international tax, where a company, most public companies will have engaged an outside provider to do some international tax, whether it be compliance or planning exercise. But then in turn, we've got individual resources in our group that can come in and help work with your outside provider to bounce some ideas off of them. And if it's valuation, of an acquired company that you need to accomplish, we've got valuation experts. And, I think it just more quickly do we introduce you to that expertise as you're approaching the transaction, so that it's not, wait until the quarter's over, wait until your experts have done it, and then all of a sudden we bring in our experts from the national office who've never had any involvement in the transaction, and they start throwing up all over it. I think, it's just a much more collaborative process, because the minute we're so involved in your company, the minute something starts happening, we get our experts involved so that they're guiding your experts through the process.
Efficiency of processes. This really goes back to the audit process and what it's going to be like if you make that switch from a Big Four or a national firm to a regional firm. One of the biggest differences is, at least for Armanino, is the lack of a checklist in the audit and kind of the whole audit approach. Matt, why don't you touch on that real quick?
So the larger firms all subscribe to either national publishing sources or have their own publishing. And basically every time something negative impacts the firm or a new issue comes out, they are going to develop a checklist to make sure that that doesn't happen again. And what we've seen is now the Big Four General Audit Procedures Program checklist is almost 400 pages. Their gap disclosure checklist is nearly 1,000 pages. And then you start talking about audit procedures checklists that are, more specific in nature, and SOX checklists. I mean, there are literally teams of staff filling out checklists for days. And what we think that does, we were sort of going down that path several years ago, and then we said, at one point we just threw our arms up in the air and we said, it just doesn't make any sense. It doesn't create a focused audit. And so we decided to throw out all checklists. We start with your financial statements. We build a single Excel spreadsheet, and on that spreadsheet is all of the audit procedures. So there is no wasted time, no trying to, fit a square peg into a round hole, and all the audit procedures are developed from the ground up. We're not starting with a 1,000-page template or 1,000 audit procedures population that we're trying to cull down and boil the ocean. And again, we think this focuses us on your financial statement accounts and the risky area in those accounts, and we make sure the partner's involved in building that audit procedures program so that you've got the right level, again, of expertise and experience focusing the audit team.
And that just really goes back to the whole restatement discussion earlier, right? The better focus, the more efficiency, the more partner time, the local decision making, all of those things go to high quality and, hey, lack of restatements, which is what everybody wants here. The last item that kind of just puts a stamp on all of this is just the fee situation. And we saw earlier that the average fee, for a typical mid-level public company was about $650,000 if you're with, the big four national firm. And if you went down to a regional firm, you're closer to $426,000. So that difference, let's just call it, 200 something $1,000 average, just, goes back to a story of fee stability, of a cost that you could budget into your operations, and ultimately reinvestment into you and to your organization. Matt, anything you want to add here?
These 2 pages actually are a company that we had proposed on. Unfortunately, we didn't win this particular audit, but again, it just gives you an idea of the fees. So as Dean said, going into 2014, their average fee was about $656,000. We came in with a 3-year fee that said it's going to be an average of $426,000. So that's $230,000 in savings, a 35% decrease. I think, again, the $230,000 is a pretty compelling number. That's at least, one new, you want to bring a new officer into the company, a new high-level sales guy. You want to, build out an engineering team. That's probably 2 guys in engineering. I mean, that's a significant amount of dollars that the company can save and reinvest into areas that are going to be more productive than, getting a single audit page.
Yeah, and let's face it, let's grow the top line, let's get more efficient, let's focus on profitability. Let's not just spend the money to spend the money. So with that said, in summary, when you're thinking about validating the switch to a CPA firm, you want to really touch upon, like I said, experience, quality, market, reaction, quality of service, efficiency of processes, and then the fee situation. In summary of today's webinar, we've talked about the current IPO landscape. We're on the same pace as the toward pace that we were on in 2014 of almost an IPO a day. We're almost at that same clip for 2015, and that doesn't even include the runway that for other folks that want to go public, which is just all consuming a lot of resources in the public accounting landscape, which is resulting in an era of fee maximization, especially at the big four and national firms. We walked through our 2015 SEC fee survey, where we really found some staggering results of the difference in fees between big four, national, and regional CPA firms. And then lastly, if you're a CFO or an audit committee and you saw that data and you want to validate or think about the switch to a regional CPA firm, we gave you the proof points that will come about in many discussions for any audit committee when making that switch.
And we actually have a survey, the detail numbers behind that survey. So all 750 companies, their audit fees over the last 3 years. I believe we've got that survey finalized and it will be available for distribution this Friday. And so that's going to be up on our website Friday, or you can email Dean or I at the end of this presentation and we'll shoot you over a copy of that.
Yeah. So with that said, that is the end of our webinar. If there's anybody on the line with questions, we'll give a minute or two with any questions to come in.
And just a reminder to everyone who's on the line today, we are going to be sending out the slides and the on-demand recording of the webinar. And as Matt mentioned, we'll be able to provide that report as well. It looks like we don't have too many questions coming in right now, but if you do have any questions, definitely feel free to contact Matt or Dean directly. Their contact info is up on the screen here. And then, of course, thank you both for participating and sharing your insights today. And then to our audience, thank you all for joining us this morning/afternoon, depending on where you are. As you exit today's survey, definitely feel free to take a moment. There will be a survey that pops up on your screen. Please take a moment to fill that out and let us know how today's webinar went so we can continue providing great webinars for you in the future. Thank you, everyone.